Hello traders, Gary Wagner here. Just after 10:30 in Honolulu, 4:30 in New York. It is Friday. Happy Aloha Friday, as we say on the islands. It is April 21st, 2017, and this is the Daily Report for Gold and Silver, our weekend review, and a quite interesting week indeed, with gold pairing much of the drawdown that occurred at the beginning of the week and mostly on Wednesday, closing fractionally lower on the week, although higher on the day. When we look at gold futures, that is currently trading at $1286.50, net change of $2.70 to the plus side. $12.80 is going to be our low, with $12.90 on the high. So a pretty compressed range of only about $10 on the day. Over to spot gold. Spot gold is trading at $1284.56. Now, interestingly enough, while gold was able to really hold onto its value, the same cannot be said for silver. Silver futures traded off about 10 cents today, but a tremendous drawdown on the week, I believe about 70 cents totally, and then most importantly, actually breaking below $18 per ounce to close at $17.91. When we look at spot pricing, much the same, $17.94 on spot. An interesting week for gold traders, and we also have a current trade on that I want to talk about, but we'll leave that for one moment. I first want to touch upon this week's activity in the market. Of course, Monday and Wednesday, we saw the market close lower. However, it was Monday's price action that drove prices just shy of 1,300 when on an intraday basis, gold prices ran to $12.97. Now we closed at $12.86 and we actually traded slightly under $12.80 this week, closing just a little bit lower, fractionally lower on the week. And you can see that expressed on this weekly candle right here, which is really in star formation, and it's truly a doji-esque. And when I say doji-esque, what I mean is although we do not have the open and closing price, meaning where the market opened on Monday, where it closed on Friday, to be a tick away or identical, it is a very, very small bodied candle and therefore moves into the realm of stars in terms of identification. This really curtails this long price ascent that we have seen occur for the last 5 consecutive trading weeks. This week, we did get a higher high than the previous week. We also got a higher low. So we have fulfilled that part of the criteria. However, we did, as I said, close fractionally lower on the week. And what I find most interesting also is the fact that if you look at this resistance line that we have drawn in, and this resistance line was actually first identified by one of our viewers have incorporated it into my current thinking, but we can certainly see that the market hit absolute resistance trading to that high of 97, and that high of 97 put prices right to the resistance line itself. And traders, one of the reasons that I feel that this resistance line carries so much weight is it is being drawn from these record tops at 1920. We're then attaching them to a point in time of October 2013 when the prices dropped to just above 1,500 and then had this triple top here at $1,800 per ounce. And also this particular area here, these recent highs that occurred at the end of last year. And so when we attach all of these highs together, we can draw a very, very long resistance line. And that is exactly the high that we achieved this week. So I wanted to spend a moment and update all of our subscribers on our current trade, the activity that we're in, and what we're looking for next week. If you recall, back on April 11th, that was a Tuesday, we sent out a special trade alert. We saw a major breakout occur, taking gold pricing above resistance. Resistance had been sitting at roughly $12.60, and from there, our subscribers got in at $12.73. And that was a point after the market had already climbed roughly $19 on the day. The breakout occurred right in this area here. We got in on the 11th and we got in right here. We kept our stops where they were. The market did come up, and here's where we hit those intraday highs at $12.97. And then as the market broke and began to trade lower, it did spike back up once again, but we did send out a suggestion to maintain our long gold positions and to move our stops, which had been sitting below 1260, to put it between 1278 and 1279. And that's when the market was trading in this area roughly at 1281. Market did come out and actually trade to a lower low. That's right here. So clients that had moved their stops up got out with a small profit. However, if you recall from yesterday's show, it was my belief that there's probably a percentage of subscribers that are still long the market, as well as some that actually pulled profits. And so I asked you to email me and let me know specifically if you're long or stopped out. And I want to thank you because I got an overwhelming response. And as it turns out, approximately 60% of our subscribers are still sitting with long positions, with the remaining 40% out having pulled profits on the trade. So therefore, we're going to handle this in a subtly different way, in that I will address both subscribers long the market and flat the market. First, for the ones that are long gold, obviously, recommendation is to maintain your current long position and to maintain your stop. I believe we had a pretty solid recovery. For those that pulled profits, my recommendation is to wait for a special trade alert that we will send out through text message as well as phone SMS message. We'll look for a dip as we did on the last trade to re-enter that so that our entire subscriber base is once again long this market, because my sense is that we obviously have resistance at 1300, but I believe that's minor resistance, with major resistance still sitting up at around 1319 to 1321. So whereas we saw gold trade lower at the beginning of the week, but trim much of those losses as we went into the close, closing only fractionally lower on the week, the same cannot be said for silver pricing. Silver pricing giving up almost 4% on the week. We can see this dramatic decline, a standard candlestick chart, and it is a daily chart. The interesting thing is when we compress this daily chart into a weekly, we get the emergence of a very simple pattern, but many times an extremely decisive pattern, and that is an engulfing bearish. Of course, criteria for an engulfing bearish is first, after a defined uptrend. Now, again, this is a weekly chart, so we can certainly say that that criteria has been met, because we had this market really move up from just below $17 to track just above $18.50. You have a market cycle, in this case a week, in which prices open above the former closing price and then close below the former opening price. Now, as you can see, it does close slightly below. Even if they were equal, I would label this an engulfing bearish. You also know, for those subscribers that have been with me for a while, that you would never take a call like this without having some sort of confirming candle. And so a confirming candle on an engulfing bearish is the following week or the following cycle. You would have the market close lower than it opened, thereby being a red candle with a lower low and a lower high on the day. Certainly an ominous signal for silver. In other markets that we follow, a Dow Jones Industrial Average did close off on the day, but a very, very interesting week with a couple of real volatile days. But we're closing at 20,547.76. And that changed today of about 30 points lower, or about 1.5% in terms of the daily drawdown. Over to the Standard & Poor's, also trading lower, off about 0.3% at 2348. And lastly is going to be the NASDAQ. Although the NASDAQ closed fractionally lower on the day, it was the one index that actually traded to a new record high intra-week. Crude oil, on the other hand, continues to fall out of grace, now below $50 per barrel. If you recall, this price descent really started at about $53. So we are now trading at $49.61, losing about 2% on the day. Of course, the dollar has had a tremendous effect on the precious metals markets this week. Dollar does continue to trade under pressure. We're looking at a daily chart, and we can see that at the beginning of the week, the market came down. We had one solid rise, but what I find most noteworthy in terms of our technical indicators is if you look at this fib retracement, and it's pretty long-term, starting at about 92 and going up to just shy of 104, so covering quite some ground at 99.23, and we've identified this price point on a number of occasions, we get a 38% retracement. We can see that historically speaking, there's absolutely some precedent for this particular price point holding some weight. Here you see it as a resistance area. Here you see it as support. Of course, we did break below that back in March. However, if you look at the lows this week, they match up quite eloquently to these lows at 38. So my question is whether or not we will see stabilization in the US dollar index, and whether we'll see a trade off and move to higher ground from this point. If in fact it does, we will get some resistance, I believe roughly at 100.20 to 100.50. It's roughly in this area here. I still believe, though, we have support at 99 on the dollar index. If we see the market begin to break through that, because I think that medium and long term we will see the dollar move to lower ground, and a break below this particular price puts us at the next support level, has to be this low at around 98.60. Lastly, we had a very interesting week in U.S. equities, and the most noteworthy characteristics was the price ascent of the tech-heavy index, the NASDAQ Composite, actually closing at a new all-time record weekly close. We're looking at a simple candlestick chart. Each candle represents 1 week. And whereas you see these red candles here, especially this one right here that does have a higher high, it certainly did not close in that area by virtue of it being red. It tells us that it closes at the bottom of the red rectangle. So our close was here this week, and then here. Now this week, you can see that the market is at 59.11, and that actually might match this or be a new record close. But in terms of the intra-week high, we certainly saw the market dynamically move to new record territory. So traders, if you recall from our technical studies that we did on today's show, I talked about the fact that our traders are split, with about 4/10 of them having been stopped out as they raised their stop, and the other 6/10 of our subscriber base still being long in the market. So therefore, we're going to handle next week a little bit differently. Obviously, for those that are in the market, you want to absolutely maintain your long position and to maintain your current level and current stop level, For those traders that pulled profits midweek, we will look for a dip at the beginning of next week, assuming that the footing in gold is still pretty solid, and look to re-enter the market from the long side. Of course, we will send out a special trade alert, both in terms of text message and SMS message to your phone. This has been Gary Wagner, wishing you, as always, good trading. Have a great weekend. We'll talk to you on Monday for another daily update and review. Bye-bye.